Right after Easter, the day after our break, the day came when Bitcoin once again surpassed $90,000. And once again, the whole trend we experienced in January or earlier in December is gaining momentum. Once more, right? So the levels that were already recorded in the crypto market are appearing once again unexpectedly, even though many people predicted further declines. And I myself still entertain the thought that a potential deepening of the correction from April 15th to the 22nd, if it were to happen, should have. But since such a situation did not occur, and we strengthened above $87,000 for Bitcoin, one might assume that indeed the worst is behind us. And a drop back to levels below $74,000 for Bitcoin is unlikely to happen. The correction was at 33%, which did not deviate too much from what happened in previous cycles and during previous corrections at this particular moment of the bull market, which is currently taking place. And of course, many people will say, Mark, what bull market? The bull market ended a long time ago. I believe that's not the case, and today I'll also prove to you a little bit why. I'll talk about how it looks and what I see from my perspective. Today, I'll elaborate a bit more on some things, so if you appreciate my materials and videos, remember to give a thumbs up. I would really appreciate it. It helps with further work. Subscribe to the channel, and let's get started with the material. So we have a bit of an Easter resurrection, you could say, because on Monday we broke through several key resistance levels, and indeed, thanks to the situation occurring, we are continuing our rally today, and the question that arises is it too good to be true? Right. Is this the end of the correction? Are we starting the last wave of increases in Bitcoin and altcoins in this cycle? Third time's the charm. Finally, because last year, March and November through December were indeed fantastic months for those who hold altcoins. Is this really another trap? And are we about to plummet, with this cycle not continuing further? So let's take a look at what the key on-chain data says at the level of Bitcoin, at $91,000. How does it relate to them? What are the correlations? What could potentially happen? What am I looking at right now? What is simply my approach to playing the market? In the near future, what is changing and what remains unchanged? Because, modestly speaking, I would wish for it to be so, but it seems that enthusiasm is slowly, very slowly returning to the crypto market. For now, of course, there are only those who were here in this market practically. No new people are coming in, which I can see from the channel, from affiliation, and so on. But the moment we break the all-time high, well, something will start happening. And it seems to me that until Bitcoin breaks the all-time high, nothing significant will happen, because it has all already happened. And it won't be encouraging for new people to join this market again. When records are talked about, suddenly people in the media pick up on the topic. And everything else, common sense and reason, takes a back seat. So let's take a look at the chart currently. Let's see what kind of movement we're dealing with, what's been happening in the last few days, essentially the last 48 hours, because, hopefully, the 74,000 was a local bottom. On the daily chart, we see more and more confirmations that the correction is ending, and a trend change is occurring, right? Bitcoin broke through this blue line a few days ago, which you can see here. I've marked it for you. And on the daily candles, we are staying above this line. We also broke through a very significant resistance of the 200-day moving average, which is also favorable. Secondly, the RSI has been signaling a bullish divergence for some time now. Here, it's marked with red lines. So in this spot, right? That's how it actually looked. We had a breakout from this level, which we also discussed. We are also breaking a higher peak, which was previously established on March 23rd, and many technical analysis signals indicate that we have reached the end of the declines. We simply have significant resistance at the level of $92,000 per Bitcoin, where short-term holders bought a lot, but it is not insurmountable. And at the same time, we are again seeing various indications that cryptocurrencies are decoupling from the traditional stock market. Because how did it end last time, right? Because, usually, when stocks fall, and Bitcoin doesn't, everyone starts to notice how strong Bitcoin is, how well it's doing, right? People start talking about it, and then, shortly after, Bitcoin falls again. But look here. At the beginning of April, we had a similar situation because Bitcoin and altcoins were rising, while the traditional stock market was falling after Trump's Liberation Day, right? Led by Bitcoin. But a few days later, cryptocurrencies followed the path of TradFi and also experienced a strong correction. Bitcoin then dropped by 12%, so remember not to get too excited too early. We still have a small period here where we might experience further correction. Maybe another higher peak will be reached. Maybe we'll return to the 80,000 level. We don't know that yet. It's not certain that, listen, we're rising like a phoenix from the ashes and everything will be good. So don't jump to conclusions. Take a look at how it currently looks now. I'm putting the S&P 500 chart on the screen for you and the declines from the last day or two. And how does Bitcoin look? So really, the situation here is shaping up quite well, at least in the short-term period. Let's say, for the cryptocurrency market. Moreover, when it comes to somewhat pessimistic data, we see that a huge number of different positions have been opened, right? On leverage. This open interest is increasing. In the last 24 hours, The most have been opened since the last month, basically. So there's a lot of it. People have gotten a bit excited and opened longs and shorts. And historically speaking, when such a situation occurred, the increases, driven by derivatives, tended to lack sustainability, right? So it kind of leveraged this growth, but then quickly caused it to end, and the momentum dissipated. And the last such significant increase in open interest occurred in March of this year, when the pump lasted just a few days, and then we had declines again. And you know, the next question is, will it be the same today, right? Today, tomorrow, or the day after? Or is it different this time? And behind the increases are not only speculators in the leveraged market, but a real, long-term influx of capital that will stay with us here. So, let's check that out now. We will definitely look at various charts, analyze what fundamental changes have been occurring in the global market recently, and simply, what is happening now? Well, what stands out is definitely the strong economic uncertainty and fear in the market. The truth is that all of this is reaching its zenith. There is an extremely negative sentiment among American investors, and stocks are falling, the dollar is weakening, bond yields are rising. So this is an extremely strange correlation. But let's also go back to the times of the financial crisis, to COVID, to every moment when there was even a hint of panic related to economic slowdown. What did we observe then? Yes, well, stocks were falling. This usually happened during times of uncertainty, but the dollar was strengthening sharply as global investors rushed to safe assets, and the yields on U.S. Treasury bonds were dropping sharply. Now we are not getting that. We have higher bond yields, we have a cheaper dollar, which means that the cost of imported goods is rising, even despite potential tariffs that are now coming into effect. So this is an uncomfortable situation that could lead to a further deepening of the crisis. And apparently it's supposed to get even worse because, as a result of this trade war, we have one of the largest banks in the world, JP Morgan, estimates the risk of a recession in the 25th year at, as you can see, 60%. And other prediction markets, such as KSI or Polymarket, also bet that the risk of a slowdown in the coming months is the highest in many years, which does not inspire optimism for cryptocurrencies to rise. And as a result of these various pieces of information coming to us from across the ocean, the US dollar has also experienced a particularly sharp decline against other safe currencies, such as the Japanese yen, Swiss franc, and also the euro. So here, the dollar has dropped significantly since December. And we have this question: where does capital flow in such complicated market conditions? Right? Because, you know, it's not like money disappears. It simply looks for other places where it can be multiplied. And this happens according to a saying that I've often quoted to you in the past, which is cash seeks yield, right? In other words, money is simply looking for a place where it can work at the highest possible interest rate. And in this post, we also have an answer to this question, because if capital is not flowing into the US dollar, and also not flowing into the American stock market, which I am showing you once again, we have a tangible effect of this right before our eyes. A 20% correction on the S&P 500, with some stocks dropping by several dozen percent, similar to some altcoins, even a lot on Solana. For example, Tesla matches these declines. Similarly, it almost matches Ether. So, you know, currently, gold is in the first place. Yes, capital is flowing here. The most important thing is that gold is not only becoming more expensive in dollars, but also in other major world currencies. For example, I bought a package of gold in December. So, you know, when you buy with zlotys, you actually have a 15% profit, right? Until today. But when you buy with dollars, you have a 23% profit, even roughly 25. Because in this case, the dollar is simply weaker than the zloty was before. And that's the correlation, that if we invested in dollars, we're even more profitable. But if we exchanged zlotys for dollars and gold, because by exchanging for gold, we are more or less exchanging them for dollars, since the ounce is counted in dollars, then indeed we are at a bit of a loss on the exchange rate difference. Many data and various pieces of information also indicate that due to recent geopolitical events, investors from around the world are moving their capital to safe assets, staying away from the USA. And this chart here clearly shows that foreign investors are currently afraid to invest their capital in America. Moreover, they are selling off their American stocks at a very rapid pace. And, indeed, it looks quite weak, because in the last 2 weeks they have withdrawn $6.5 billion from American funds, which is simply the second largest amount in history, and the outflow was only slightly lower than the $7.5 billion recorded during the banking crisis in March of 23rd year. And the sell-off also threatens American bonds, because if there is a further decline in confidence, foreign investors hold a massive amount, well, $18 trillion in American stocks, which constitutes a full 20% of everything. So 1/5. If this decline continues to deepen, then foreign investors might actually withdraw a significant amount of funds because 1/5 is, well, not owned by Americans. And take a look at this entry as well. It shows the behavior of corporate insiders. And here, the ratio of these insiders buying to those selling rose to 0.42 in April, which is the highest level in 16 months. In the first 2 weeks of April, 180 corporate executives bought their shares, while 451 sold them. And in the last 30 days, almost 500 insiders bought and over 1,000 sold, which raised the ratio to 0.46. So the ratio of buyers to sellers is still over 50% lower than the value of one recorded during the bear market in the 22nd year, when purchases were at their highest. This raises the question of whether buyers are slowly returning to the market, and if now insiders, people who often have various resources and information, will start buying up this dip more aggressively. Here, in this post, we have an interesting interpretation of this statistic, because the idea is that if insiders were truly bullish about their companies, there would be significantly more buyers. It's too early to conclude that, the dip is being heavily bought up, because the ratio of buyers to sellers is still quite low. The key question and speculation is exactly why these buyers are positioning themselves, because perhaps this is just the beginning of larger purchases by corporate insiders, who are somewhat front-running. Let's call it the next interest rate cuts and liquidity improvements. Well, this is definitely something worth watching. For now, let's also focus on what we actually know now and where capital is flowing in the largest amounts. Because what we know and see, well, what is the entire market investing in? Where is the capital going? In the first place, it's gold. It is perceived as a safe haven. For a few months now, it has had no equal in terms of safe growth. Let's call it in quotes, meaning without the risk of a huge downturn. And here I remind you that physical gold has gained from geopolitical uncertainty since the beginning of the 25th year, achieving a remarkable result of 30%. Back in January, it cost $2,600, and now you have to pay $3,500 per ounce. So this metal is hitting new historical highs week after week, and I'm personally curious to see where all this will stop. We have a bit of a FOMO rally, don't we? And since the beginning of the year, gold has outperformed the American stock market by 42%, which speaks to its extraordinary strength and the narrative of being a safe store of value in uncertain times. Because gold is rising, the S&P 500 is falling, and the market is beginning to see the true value and inflation hedge in this precious metal. You could say that everyone is buying gold at a time when trust in fiat currencies is decreasing day by day. And here, too, the Chinese central bank has publicly reported that it has been buying for the 17th consecutive month. We're talking about their reserves shown on the balance sheet. And they probably have a bit more of this precious metal, even off the balance sheet. And this chart here also makes us realize that gold ETFs are experiencing their golden period, as they have never experienced as many purchases in history as they have recently, which is also reflected in the price. Here, just look at the chart to see how it currently looks and presents itself at the moment. Simply put, besides gold, capital is flowing into currencies other than the dollar, right? And also into Bitcoin, currently. But more on that in a moment. One of the currencies that is gaining the most from the weakening of the dollar is the Swiss franc. The franc is gaining not only because of interest rates, but also due to what it symbolizes: political neutrality, low debt, a high budget surplus, and strict capital control. This is a place where capital hides when trust in both superpowers wanes, so the currency gains. Also here, the author of the tweet, see in the fourth point, wrote that sovereign bonds outside the USA are becoming a safe haven, because, according to him, it's not about chasing the highest income, but rather allocating capital in jurisdictions without record deficits. Or, let's say, weaponizing the currency. That can be called safety outside the USA. And at the very end, he also mentions Bitcoin as digital gold again, because physical gold is not the only beneficiary of these political upheavals in recent days. But here, Bitcoin also gains. And let's check now whether this joint Bitcoin rally and the shift towards perceiving Bitcoin as a safe asset could actually be a significant turnaround or just holiday noise. Because the truth is that slowly Bitcoin is becoming a topic of conversation in the context of protecting capital not only from inflation, but also from the instability of fiat currencies. But altcoins are not part of this conversation, of course, and we have to accept that. Bitcoin has always led the crypto market, and currently, we see that in this final phase of the bull market, it will be no different. And I will mention the altcoin market at the end of this video. They are currently waiting for slightly better monetary conditions. Because look here, so, while waiting in the market, Bitcoin is currently the safest choice. Recently, it has been behaving quite differently from Nasdaq, which mainly consists of tech companies. Until now, Bitcoin followed the footsteps of this index, but it's undeniable that we're entering different times. Although it traded similarly to Nasdaq, it doesn't have the same fundamental characteristics as Nasdaq, and the market is slowly starting to notice this. While this index was never seen as a safe haven, Bitcoin not fully yet, but very slowly is gaining that status. And its global legitimization fully confirms this. And although physical gold has long been considered a safe haven asset, Bitcoin has not had such a narrative since the beginning of this year. But also stop and think that the S&P dropped 22% at its peak, while Bitcoin fell 33, which is barely 10% more, considering it was also dropping from its all-time high. It is a cryptocurrency, not the largest American companies in the world, in a fund that aggregates them all. So think about it, is a 10% larger drop than the largest collection of companies in the world, in one place a big drop, or not? I believe that Bitcoin is doing very well currently, and breaking the all-time high is really a matter of maybe weeks or 2 to 3 months. I assume that this will indeed be the case, and then, proverbially to the moon. And $100 and some thousand this year is definitely possible. So people who haven't bought Bitcoin yet still have a chance to earn 50 to 80% realistically this year. I have such a supposition. It's not a confirmed fact. It doesn't have to happen. But there's simply a good chance of it. That's what I think. And also the American indices, including NASDAQ of course, have been losing due to the trade war in recent months. Along with them, Bitcoin was losing value, and the Pearson correlation for many months indicated a high positive correlation between Bitcoin and NASDAQ, which reminded us more that Bitcoin is a technological asset, rather than a safe haven and digital gold. And in recent weeks, the situation looks a bit different. Because the traditional stock market is bleeding, and Bitcoin is gaining. We see that they have decoupled from each other, and Bitcoin is coming out on top in this correlation. So the question is the narrative of capital fleeing to Bitcoin returning? Will the increasingly positive sentiment building around Bitcoin cause the bull market to return? Let's also take a look at a few things that answer these questions. Firstly, on-chain data consistently indicates that the Bitcoin bull market is still ongoing. There are no signs of distribution. Once again, I'm showing you the chart with the number of whales, but it's very important. We keep track of it regularly and update it for you here, so it's worth subscribing to the channel. Looking at this chart might already be boring, but you also can't ignore the fact that the number of whales is still close to its cyclical peaks and is still in an upward trend. And this is a clear sign that big players see potential in Bitcoin and don't want to get rid of it despite geopolitical turmoil. Another indicator also shows us that declines in the traditional stock market are not deterring investors from simply investing in and accumulating Bitcoin, because the last 2 weeks on this accumulation trend score show a slow upward trend, which means that once again, increasingly larger entities are eagerly buying Bitcoin, not yet on a massive scale, but something is happening. And you know this kind of local growing accumulation is not yet synonymous with the fact that the general public and new investors are entering the market, but it tells us what's currently going on behind the scenes. This chart perfectly illustrates one thing. The recent weeks have been a continuous rotation of Bitcoin supply into the hands of long-term holders. Look at the loops going in both directions here. In short, this simply means that, overall, more Bitcoins are maturing in wallets than are being bought on exchanges by new players. And more investors are simply adopting a holding strategy, not selling their bags. And this isn't necessarily a bad thing, but a better scenario for Bitcoin, and especially for altcoins, would be if the supply of Bitcoin flowed more strongly into the hands of short-term holders during an upward trend, because such dynamics, along with increasing accumulation, usually occur in the banana zone. And then we have greater excitement in the market, combined with a greater willingness to speculate in the altcoin market. And the current conditions favor Bitcoin for now, and one must patiently wait for the altcoins. I also mentioned that gold ETFs are experiencing a real buying frenzy. Looking at the table here, we also see inflows into Bitcoin ETFs. That frenzy is not visible here. Most days at the beginning of April are in the negative by 100, 200, 300 million. If there are any positives, it's by tens to $100 million. So, on Easter Monday, purchases were made for $380 million. Of course, not counting the outflows, which are marked here in green. And listen, this was the best session in 3 months, which shows how poorly things were going with Bitcoin ETFs, and how much everything just had to endure here. And I remind you, there were also days when $1 billion landed in Bitcoin ETFs, just for example in January or December. So we still have to endure a bit to return to those times. It's also worth mentioning that public companies are continuously increasing their exposure to Bitcoin. Already over 700,000 Bitcoins, which account for more than 3% of the supply, are in the hands of companies from around the world. It's a trend that cannot be ignored, because it is such a strategic asset for serious entities worldwide, and privately we can do the same. Simply put, Bitcoin is helped by the weakening dollar, among other things, to thrive in this dimension, and the dollar continues its rapid weakening. The DXY just broke through the level of 98, which marks the lowest point since March 22nd. And this is a macroeconomic warning signal for Bitcoin and gold. This is the perfect fuel, right? Both assets are rising on the wave of the same phenomenon, simply escaping the risk associated with the dollar. And if the current trajectory continues, Bitcoin may strengthen its status as the digital equivalent of gold, especially in the eyes of institutions seeking nonlinear exposure to a store of value. So we simply see such positive data for both Bitcoin and gold because, digital or non-digital, gold is winning as capital flows towards safe and inflation hedging assets. Bitcoin and gold are and will be the main beneficiaries of such a shift away from long-term risk, denominated in dollars. For now, gold and Bitcoin are strong, and the market is, simply, looking for a safe haven and finds it in these two assets, right? But one more question. As we slowly approach the end, let's go over what could cause cryptocurrencies to return to a growth path in the coming weeks, and what might potentially happen for that to occur. Firstly, the nervousness in the markets is intensifying due to Donald Trump's constant calls for interest rate cuts and speculations that he might be looking for legal ways to remove Fed Chairman Jerome Powell. Trump wrote on the Truth Social platform that many are simply demanding interest rate cuts. He also claims that inflation is falling and that maintaining high interest rates could cause further damage to the economy due to its slowdown. And it was mentioned here that Europe has already cut rates 7 times. Powell has always been late, except during the election period when he cut rates, to help sleepy Joe Biden and later Kamala win the election. And that's a strong quote that Trump directed at the Fed chairman. So the question is, will Powell cave under pressure? Because the majority of market participants are betting that there won't be any cuts in May and we'll have a pause. However, in June, the market expects a cut, as you can see. It will likely be the first cut in 7 months by 25 basis points. We currently have almost 90% probability for this. And potentially it's a good scenario for the altcoin market, because until then it's possible that alts won't be performing well. And for now, it looks like the Bitcoin season will continue, especially if the narrative of digital gold returns. The monetary conditions won't favor altcoins at the moment. And of course, such a scenario seems unlikely, because here, it's indeed worth observing. In my opinion, the dominance level of 73% of Bitcoin. As in the past, we had a strong reaction twice from this level. In September 2019, when the Fed started the last QE, and at the end of 2020, when a full-fledged altcoin season began in that cycle. Currently, Bitcoin's market dominance is around 64.5% to 65%, and it's far from the mentioned 73%, but such a scenario is in play, and the first level worth observing is 66%. We're already very close to it. We could also shift a bit in favor of alts, to at least give them a chance to gain some momentum. There's a chart I mentioned a moment ago, and speaking of September, we'll add Ethereum to Bitcoin here. This is not only an important date due to the start of the last QE by the Fed, or the peak of Bitcoin's dominance, but it's also significant because, at that time, the Ethereum to Bitcoin pair reached its low at 0.016. Look at the chart, I've overlaid it here for you, and we are very close to that level. Currently, we have a valuation of 0.018 on the Ether to Bitcoin pair. I didn't expect such levels myself. I was betting that it would rebound much faster now. And previously, it did rebound that profit on dominance at one time, but we simply had too small a range to cash it out. I didn't do it myself, just like practically everyone in this market. So potentially there is still room for the Bitcoin price to drop to almost prehistoric lows from 2019, 6 years ago. There, a key support awaits us, perhaps with the start of another round of QE. It will be the moment of trend reversal on this chart. Because if Ethereum were to start its rally after the beginning of QE, I personally am counting on that. Of course, and then it should positively impact the entire altcoin market. Well, honestly, the rest of the year looks like it's going to be a crazy period for altcoins. The third and fourth quarters could be very strong if everything aligns. And we'll wait a little longer. And yesterday, Atkins Paul was officially sworn in as the new head of the SEC. Well, he is known for his pro-crypto altcoin views and will definitely try to help this sector within his mandate, rather than hinder its development. I mean, hopefully, that's how it will be. He will have a lot of work because there are over 70 ODF applications for cryptos to review. Most of them, of course, are on altcoins. For example, a lot on XRP, a lot on HBAR, on Solana, Litecoin on AVAX. For example, there are on Dogecoin. On Polkadot, actually. The most are on XRP, on Solana. On Litecoin, I think not. And on Dogecoin, there are a few, maybe 2 or 3. So we'll see how it goes. In summary, the question is whether Bitcoin above $90,000 is just the result of such an impulse, or a symbolic shift in the global investment narrative? Well, we'll only find out in a week or two, as the matters I described in the video today become clearer. But, generally, I think, it's worth staying vigilant all the time. I regularly average my purchases. Take care. Bye.